And on today's show, our introduction to disability insurance and policy option designs. Part one of this week's series on Disability Insurance Awareness Month for 2014 with disability expert Tim Kukeza. Hi everyone, I'm Steve Savant, syndicated financial columnist and contributing author to Background Technician in Innsmark. Let's get down to business. Well, welcome to the show, Tim.
Thanks, Steve. Thanks for having me.
I'm happy to bring in DI month. We are the most neglected insurance policy there is on the face of the earth, and you know what, it shouldn't be. I just got done blogging on paycheck protection and qualified plan contribution coverage. I mean, those are the two most important things to every American, and yet nobody talks about it. But give us an introduction into DI, because I think people really want to understand it, and maybe that's why we're having such a struggle sometimes incorporating it into an advisor's thinking.
Yeah, I mean, I love the idea of paycheck protection, that's for sure. I mean, that's what this insurance is it's income protection. And most people out in the marketplace rely on their income for everything that they do every day, all day long. And for them not to be able to, or not interested in protecting that income and having agents not advise them about paycheck protection, it's just a lost opportunity. And it's something that all of these clients need to at least be aware of, that they can go out and have a product that protects their income if they get sick or hurt.
A lot of young people think, I'll wait on DI till maybe I'm in my 50s.
Yeah.
What's the deal on that?
Yeah, I mean, everybody thinks they're invincible, that's for sure. And waiting at that point in time, there's a couple of different things. We all know that the DI policies are priced based upon your age. So the earlier you get the policy, the cheaper the policy is going to be. And from a health issue standpoint, you know, disability insurance is underwritten just like other insurances. And the disability product, now underwriting has changed over the last couple years and it's gotten considerably better, but still there are some issues associated with, as you get older, the policies might be a little bit tougher to get from an underwriting standpoint. So the younger you get it, the easier it is to get and the cheaper it is.
When I came into this business, our general agent made everybody get DI. I didn't really want to spend the money, I have to say and confess. But then I went down, I tore my Achilles heel in a tennis match, and I was down for 9 months, and this is before we had the technology of repair and rehabilitation. I got paid by the Provident for my disability. It was a game saver for me. I was a young, married couple of young kids. I could not have afforded. And you're thinking, wow, that happened in my 30s, not in my 50s.
Yeah, you know, when you look at disabilities, you look at things that people think that are very, you know, life-changing and things like that. But a typical disability may only last 9 months or 12 months. But think about going without a paycheck for that long of a time. You know, you're not going to be able to function properly. There's stress associated with the family and you as an individual. Without a paycheck, how do I get through the next month or two? So when you look at that and you know that it's a situation that maybe you're riding your bicycle and you fall off your bicycle. Good friend of mine, that happened to last summer. You know, he was out of work for 7 months. Hit some loose gravel as he's going around a bend on a Sunday morning. These guys take bike rides on a Sunday morning. Next thing you know, he's out for 7 months because of the injuries he sustained just riding his bike on a Sunday morning. So that type of protection helps him get through those 7 months of being not able to go to work.
When I think about disability, I think a lot of people think, well, if I have a problem, I'll just get Social Security.
Yeah. If you watch any shows in the evening, especially on cable, you see multiple attorneys talk to you about, have you been denied Social Security disability benefits? The Social Security program is a great program, but it's a program that very few people end up qualifying for. It's very difficult to qualify for. Most often or not, you do have to get an attorney's help to help you qualify for that coverage, and the benefits are limited too. And the definition of disability is very rigid. So it's a hard program to get. You have to be disabled for a number of months before you can even qualify for it. And there's a cap. So that might be the true safety net, but there's other ways to ensure your income.
I'm thinking of most people in America, and this is a statistic that's been around for at least a decade. Most Americans have about maybe 60 to 90 days in cash reserves. That's about it, really. And their actual indebtedness, and I'm going to exclude mortgages for a moment, their actual indebtedness is short-term, high credit card payments. So 90 days, you know, they could be in trouble. And so when I look at cash reserves, if we had 2-3 years in the bank, maybe people say one thing, but most Americans are normal. If they have 60 to 90 days, that's the top out. So when I'm looking at disability, I'm thinking about, I need to really think about DI coming online in my life to pay me a paycheck about 60 to 90 days out because that's all I have.
Yeah, and when you talk to a number of producers out in the marketplace, you know, that 90 days nowadays, a lot of people don't even have the 3-month rainy day fund set aside. So in terms of getting to that point, 90 days is a great break even or a great break point for price-wise on a disability policy. But you're right. I mean, if those people have 90 days, that's all that they have.
When we come back from the break, we're going to talk about some disability options that you can look at. One of them is the duration time, and what we're talking about now is the period, the elimination period. We'll be right back. Back in the day, life insurance professionals were called field underwriters. Then, carriers trained their field force in the basics of life insurance underwriting. Today, the insurance industry doesn't educate the agent population as they once did. But now you can have the Informed Risk Guide at your fingertips so you can illustrate a reasonable rate class for your life insurance prospects. Just request your copy of the Informed Risk Guide at downtobusiness.ashbrokerage.com. It's free from Ash Brokerage, the practice enhancement company. Well, welcome back to the second segment. Of course, I'm with a DI expert, Tim Kukeza. Tim, we're talking about options now, different ideas. One thing we just already alluded to is the elimination period. Yeah. Give me some of the broad brush ideas. What kind of elimination period can I have?
Yeah, you know, as I mentioned, the 90-day is a typical price break in a situation that allows the client to get good protection for a premium that makes sense. You can go out 180 days, a year, you know, for people that have a lot of those assets set aside, as we talked about. You can even go 2 years in some situations.
On a regular individual DI, you can go out all the way out to 24 months.
In some states, with some carriers, you can go out to 2 years. Wow. Now, you can back that down and go down as low as a 30-day on a long-term disability, and then you can also get into short-term disability products that go even to a 7-day elimination period. Now, those become a little bit pricey, of course. Even a 30-day on a long-term becomes very expensive compared to the 90-day.
Now, you said in the phrase the 90 is kind of like the break. That's where America's kind of living. Now, I was kind of intrigued, though, 2 years out. If I had a short-term disability on my group, and it ends in a 2-year period, which a lot of these do, maybe that would be a good time. If I couldn't do anything else, that might be an option. Yeah,
that's a great point. I think that's why you see those 2-year elimination periods out there, because for those people that have a typical type of group plan, 2 years tends to be a long time for a short-term program, but even a year or 6 months, and then basically you coordinate around the employer-sponsored short-term disability plan, and then you put the 90-day, the 180, or the 1-year wait on the long-term plan.
All right, now let's say I've scheduled out. I know I'm going to go ahead and I'm going to use that elimination period. Now, on long-term disability, I could go out farther, right? It could be 5 years. It could be, how many years could I go to? Age 65, I guess.
Yeah, and even some carriers now are going to age 70 in terms of the benefit period. Okay?
Wow, that's long. Since I've been in this business, we never had that in the beginning.
Yeah, over the last couple of years, that's just changed. When you look at the change in the Social Security age now, and people are working longer, they understand that they need to protect their income for a longer period of time. So some of the carriers now are going to a benefit period of age 70 if you become disabled. There used to be the lifetime benefits. That's back in the day. Most of that has gone away. Some of the carriers still have some lifetime benefit options, but they tend to be very expensive because you can imagine, you know, you're talking about disability benefits for as long as you live, and that can be very expensive.
When I'm thinking about my elimination period, the duration, how long I'm going to carry this, when you're looking at different writers, different options, what's one of the writers would you say, hey, this is an important one? There's a lot of them. Give me an important one.
Yeah, I think the most critical is the residual writer. Some people will refer to that as like an extended partial. So that way, if you are working 4 hours a day versus 8 hours a day.
So you're disabled.
You're disabled. Let's say you have a back issue. And your physician says to you, okay, I want you to start going back to work, ramping yourself back up, but now I only want you to work 4 hours a day for the next 3 months because your back can't take the punishment of you sitting at your desk for 8 hours a day. So without that residual or extended partial, your policy is a total only disability policy, so it's not going to pay you any benefit. With that rider, in this situation, let's say that that's 50% of your income now, that residual rider is going to allow you to collect 50% of your disability benefit because you're working 4 hours a day versus 8 hours.
So that's an transition.
And that's an important rider that you have to have on those policies.
I'm wondering when I'm thinking about having, and I like the idea of residual because it kind of eases me, segues me back into my work. What about inflation? If I'm a young guy, because we talk about buying DI in our 30s, okay, I'm there, I was disabled, so I know. If I'm using, can I use an inflationary rider to keep pace with that so it's growing? And is it worth it?
Yeah, well, there's two things to look at. One is there's an inflation type of rider for actually when you're disabled. So the COLA rider kicks in once you become disabled. So for every year after your first year of disability, your benefit increases by, let's say, 3 or 4 or 5% based upon the carrier and the product. So
Can I stop you there?
Yeah.
You said up to 5%?
In some situations, yeah, 5 or 6% in some situations. Yep.
6%. Wow.
Yeah.
See, to me, that is huge. Now, have you seen, what's the disparity, just from a general point of view? If I'm at 6%, am I adding what, 10% to my DI premium, 15%?
Yeah, and that's the one thing that we look at. With the COLA rider, sometimes it can be as much as a 20% increase on the policy itself, all right? So the COLA rider, to your point, it is a rider that we see a lot of people proposing, okay? But again, it only kicks in once you're disabled. Now, most disabilities, when you look at the statistics, you mentioned statistics earlier, last less than 5 years. The majority of them last less than 3 years. So the COLA rider definitely is a rider that, yes, my benefit's going to lose purchasing power over a long period of time, but also if your disability is only going to last on average 3 years, that's a rider that not everybody needs on their policy, and it does add about 20% in some situations.
I was thinking if I'm an executive benefit and I'm in my 50s, maybe I'll look at that as a more of an endearing. Give me one more before we close out our show. Give me one more you think, like, here's a rider that you should consider when you're talking about individual DI.
Yeah, you have to, especially for the younger people, consider a guaranteed purchase option rider. So that gives that person the ability to buy more disability benefits sometime in the future without proving medical insurability, all right? So it's a very inexpensive rider, and again, as your income goes up, because disability benefits are based upon income, as your income goes up, if for some reason you become uninsurable, let's say it's diabetes or a height and weight issue, with that rider, they don't look at your medical insurability at all. So here you are, you need more monthly benefit because your income has gone up, okay, and you now become uninsurable medically. It doesn't matter. As long as your income justifies the increase, you're allowed to purchase more monthly benefit. So that's a really important rider.
I love that rider, and I think it is very important. Well, that's all the time we have for today's show. Remember, before moving forward with any of the ideas you hear on our show, always consult your tax advisor, legal counsel, or your broker-dealer compliance officer. Missed an episode? Just hop out to our site, downtobusiness.ashbrokerage.com. And remember, you could be wiser as an Ash Brokerage advisor. I'm Steve Savant. We'll see you.